So why did your absolute favorite artist just cancel their massive stadium tour? And honestly, more importantly, why is that cancellation actually a flashing red warning sign for the entire stock market? Welcome to The Explainer. Today, we are unpacking this massive, completely hidden structural disaster that is quietly looming behind the world's biggest entertainment events. Now, if you've been following the financial markets, you already know commercial real estate has been a major talking point. But the crisis we're diving into today, it's not about those empty office buildings in downtown metro areas. No, it's about massive, multi-million-dollar stadiums. We're going to explore how something called the Blue Dot crisis is literally threatening real estate and venue liquidity on a systemic level.
There's this quote that just perfectly nails it. Empty seats at Post Malone aren't just a music problem. They're a commercial real estate ticking time bomb. That captures the brutal truth of what we're actually witnessing right now. Think about it. When a global icon cancels stops on a stadium tour because of low ticket sales, sure, it creates this highly visible cultural moment. But beneath the surface? That cancellation sends a massive shockwave straight through the financial markets. It threatens the highly leveraged real estate investment trusts, the REITs, that own these massive single-purpose buildings. Look, these aren't just passive structures made of concrete and steel. They're complex financial instruments carrying enormous loads of debt, and they rely entirely on packed houses to pay that exorbitant interest.
Okay, let's dive into this. Here's our roadmap. First, the Blue Dot ticking bomb. Second, funflation and the OPEX trap. Third, a monopoly on nothing. Fourth, the experiential REIT contagion. And finally, number 5, mining alpha from empty seats.
Starting with Section 1, the Blue Dot ticking bomb. We're looking at consumer sentiment and price elasticity here.
Look, if you've logged into a ticketing platform recently to grab a concert ticket, you have probably seen this exact disease firsthand. It's kind of clinically referred to in the industry as blue dot fever. It's that phenomenon where unsold ticket inventory appears as just a literal sea of blue dots on those digital seating maps. Now, for years, investors thought the premium experience economic model was completely invincible. Right after COVID, we had that massive revenge spending boom, and the market was just flooded with false confidence. Investors truly believed we had entered this recession-proof permanent shift where younger generations would always choose experiences over things, basically regardless of the cost. But as you'll see, this sea of blue dots indicates a total failure of that model.
Just look at this jarring 75.6% price difference. Back in 2020, your average ticket was about $82. Fast forward to the 2026 fiscal reality, and it has surged to $144. And let's be real, a typical nosebleed seat after fees, you're easily paying over $200. This level of extreme price extraction completely wipes out any consumer surplus. If a fan is literally draining their entire discretionary budget just to get their foot in the door, there is absolutely zero margin left for anything else. I'm talking about the $15 beers, the exorbitant parking, the merch. And that ancillary spend is the exact revenue stream that venue owners desperately rely on to actually generate their required yield.
Moving into Section 2, funflation and the OPEX trap. Let's get into the brutal arithmetic of touring sustainability.
Let's actually walk step by step through the 2026 touring math, because it's wild. It starts on a global scale, the conflict and maritime instability over in the Strait of Hormuz. Roughly 20% of the world's oil goes through there. This geopolitical shock sends crude prices absolutely soaring, pushing gas to near $8 a gallon in high-demand U.S. hubs. And since live music is, at its core, a massive, high-frequency logistics business, these costs are just devastating. Moving a stadium stage requires a small army of personnel and a fleet of maybe 30 to 50 heavy-duty trucks traversing the entire country. Those logistics costs, they've tripled. Fuel and transport have literally become the breaking point for a tour's viability. So as a direct result, a stadium's required break-even point has violently shifted from a historical norm of about 60% occupancy all the way up to an impossible 90%. So if an artist looks at a map and sees its 50% blue dots, the math simply collapses. The tour gets canceled.
And that brings us to the internal OPEX trap inside the venues themselves, what we like to call funflation. Even when tickets actually sell, the operating expense spikes are just devastating. Headliner guarantees, up 100%. Security and labor premiums, up 12 to 18%. Energy costs to simply light the massive stadium are up 25%. Event insurance is up 40%. We actually have a perfect case study with Madison Square Garden Entertainment. In a recent quarter, they reported massive top-line revenue, but their operating income completely plummeted, down 41% year over year, simply because of these direct venue operating costs. The cost to literally just keep the lights on and the doors open is eating them alive. Which leads us to Section 3, a monopoly on nothing. Let's talk about the antitrust reckoning. Okay, so investors have long loved Warren Buffett's famous toll bridge moat analogy, right? It's the whole idea that if you own the only bridge into town, you can raise the toll forever and people have absolutely no choice but to pay it. But we really have to look at the toll bridge inversion here. Think about it. If the toll eventually costs more than the traveler's entire net worth, they just stop crossing. And then what happens? The bridge owner goes bankrupt paying the fixed maintenance costs. Investors mistakenly thought Live Nation was this invincible toll bridge. But unlike a real physical bridge where a traveler can just, turn around and go home, Live Nation built an entire sprawling ecosystem that relied on that toll. By pricing out their own customers, they were leaving their massive, incredibly expensive venues completely empty, meaning a collapse at the toll booth takes the entire ecosystem down with it.
Now, what's really interesting about this next slide is the regulatory fallout. Back in April 2026, a federal jury delivered a clean sweep against Live Nation, and man, the DOJ mandates are brutal. They have to divest their exclusive booking agreements, they're forced into open venue operation, meaning rival companies can now distribute 50% of the tickets. There's a hard 15% cap on ticketing service fees, and they have to allow back-end interoperability for competitors. All of this essentially cripples that highly profitable ticketing flywheel that historically subsidized their high-risk concert operations.
It all comes down to this brutal truth. Investors saw the word monopoly and immediately thought safe moat. They were completely ignoring that a monopoly on a product literally no one can afford is just worthless. Controlling an empty market, it's just an illusion of safety.
All right, Section 4, the experiential REIT contagion. How do we actually go about valuing the empty machine?
Remember the massive WeWork office collapse back in 2021? WeWork basically left all these landlords holding millions of square feet of completely unleasable commercial real estate. Well, the 2026 stadium liquidity crisis is an exact parallel. An empty stadium is really just an oversized, unconvertible empty office building. You can't just magically turn a 70,000-seat amphitheater into cute residential apartments overnight. If a shopping mall fails, you can partition it. If an office fails, you can convert it to mixed use. But a stadium? If it goes dark, it generates absolutely zero revenue, but it stays saddled with massive fixed debt service and huge depreciation.
And this acts as a really severe stress test for specialized experiential REITs. On one side of the matrix, we have EPR properties. They're heavily exposed to movie theaters and amusement parks, which means they are highly dependent on consumer attendance and facing intense blue dot pressure right now. On the other side, we've got VCI properties. They're an S&P 500 powerhouse, owning huge Las Vegas casino mainstays. Ostensibly, VCI has a much safer moat, right? But are they immune? Definitely not. Let's just follow the step-by-step logic here. If gas is super high due to those geopolitical shocks we talked about, flights become prohibitively expensive. When flights are expensive, the volume of fly-in visitors to Vegas inevitably drops off. If Vegas stays empty, the revenue needed to support VCI's 30-year master leases basically vanishes. The macroeconomic web connects all of them.
So here is the fundamental commercial real estate math that spells out the disaster. We call it the mid-cap squeeze. Asset value in real estate is calculated by dividing net operating income, or NOI, by the capitalization rate, or the cap rate. Let's just break that down super simply. Your net operating income is your profit pool. Your cap rate is essentially the required rate of return that an investor demands. Now, when interest rates in the broader economy are high, investors demand higher cap rates to justify the risk. As we just saw with fund inflation, venue operating costs are skyrocketing while ticket demand completely stagnates. That means the profit pool, the NOI, is shrinking rapidly. When you divide a shrinking profit pool by a higher required rate of return, the math literally, mathematically forces the underlying value of the building to crater. There is absolutely no escaping that formula.
And guys, this contagion spreads way past just the REITs themselves. We're talking massive macro fallout. A lot of these stadiums are heavily financed by municipal bonds. Local cities build these gigantic venues relying on taxes from nearby hotels and rental cars to pay the bond off. So when the stadium goes dark, those tax streams dry up instantly. The city risks defaulting, leading to municipal bond downgrades, which directly threatens local government funding. It escalates the whole crisis from a corporate failure to a literal municipal disaster. Plus, private credit lenders who stepped in to finance these single-purpose developments, they're facing total yield failures. A structural shift away from live events creates these massive liquidity vacuums in the secondary markets. Okay, on to our final section, Section 5, mining alpha from empty seats. Let's look at the leading indicators for asset vacancy.
This is exactly what savvy investors are tracking right now to find actionable alpha, and this brilliantly illustrates the trend. Just look at this localized warning signal, the search volume index for concert cancellations. It has spiked from a baseline of around 10 all the way to a massive peak of 94. This surge in consumer search volume, it isn't just pop culture gossip. It's a highly localized leading indicator for real estate vacancy.
And to add to that, we have the streaming disconnect. If you look at Luminate data, which is pretty much the absolute industry standard for music streaming metrics, a median concert usually generates about 42% growth in local streaming the week of the event. But today, modern buzz has completely decoupled from actual ticket sales. An artist might have huge localized streaming numbers, right? But because of that extreme price barrier we discussed, the tickets just sit there. They don't sell. For investors, this exact formula, high local streaming plus low ticket sell-through, is the ultimate alpha shorting signal. It proves beyond a shadow of a doubt that online popularity does not pay the stadium's rent.
$6.6 billion. Let that number sink in for a second. That is Live Nation's reported event-related deferred revenue for Q1 2026. Now, this number looks amazing on paper because it reflects tickets sold, but it does not reflect the viability of the shows that actually haven't happened yet. And here is the hidden trap. This deferred cash has likely already been earmarked or straight up spent on operating expenses just to deal with funflation. If Blue Dot Fever forces a 20 to 30% cancellation rate in the back half of the year, refunding those tickets requires cash on hand that the venue might no longer have. That $6.6 billion instantly transforms from deferred revenue into a catastrophic liability of mass refunds. It triggers total insolvency.
So I'm going to leave you with this pretty provocative final thought to mull over. If the audience decides the experience simply isn't worth the debt, what is an empty stadium actually worth? When the toll is just too high, the bridge becomes nothing more than a liability. Those blue dots are a countdown, and the real estate market is going to have to face the music very soon. Thank you so much for joining me for this explainer. I really hope this deep dive gave you a powerful new lens on the markets, and I cannot wait to explore more of these hidden economic forces with you next time.